Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Omnicom Group was formed in 1986 through the merger of BBDO, DDB Worldwide, and Needham Harper Steers. Today, it is one of three dominant global advertising holding companies alongside WPP and Publicis.
The portfolio includes advertising's most storied agency brands, BBDO, DDB, TBWA, and OMD Media. These agencies hold creative and media mandates for global brands across virtually every consumer category.
Advertising and media is the largest segment at roughly 57% of revenue, spanning traditional creative services and media buying, where scale delivers the greatest negotiating advantage.
CEO John Wren has run Omnicom since 1997, a 27-year tenure. His longevity reflects both the client relationship continuity he has built and the financial discipline he has consistently applied.
The business model is built on agency of record relationships. Major brands tend to stay with their primary creative agency for years or decades, creating revenue visibility and deep institutional knowledge.
Omni is Omnicom's proprietary data and analytics platform. It connects client first-party data with third-party audience intelligence, enabling precision targeting that makes advertising demonstrably more effective.
The 2023 Flywheel acquisition added commerce media capabilities, allowing Omnicom to manage retail platform advertising on Amazon and Walmart, alongside traditional media buying and creative agency mandates.
The announced acquisition of Interpublic Group, if completed, would create the world's largest advertising holding company, a major consolidation response to growing competition from tech platforms.
EBIT margin runs around 15%, consistent with the agency holding company model. The business is people-intensive, so margin expansion opportunities are limited relative to asset-light software platforms.
The dividend has grown for 11 consecutive years, sitting at $2.80 annually. Free cash flow of roughly $2 billion per year funds the dividend and consistent share repurchase programs.
Organic revenue growth of 5 to 7% is the baseline expectation, driven by digital and precision marketing demand. Cyclicality exists, ad budgets are cut in recessions, but diversification helps.
Competitively, the advertising landscape has shifted dramatically with digital platforms. Google and Meta capture most digital ad dollars directly, which puts meaningful pressure on agency media buying margins.
The structural response is to move up the value chain into commerce media, data analytics, and precision targeting, where agencies provide capabilities brands cannot build internally at equivalent quality or scale.
Public relations, healthcare communications, and precision marketing each contribute meaningfully to the revenue mix, providing diversification that reduces dependence on the cyclicality of traditional advertising spend.
The international footprint spanning over 100 countries gives Omnicom the ability to serve multinational clients consistently across markets, a capability independent agencies and regional players cannot match.
For communication services investors, Omnicom's combination of blue-chip agency brands, proprietary data platform, and long client relationships makes it among the most defensible positions in global advertising.
That's the company chapter for Omnicom Group. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Omnicom beat Q1 estimates by 3.3%, while simultaneously absorbing the complexity of the massive Interpublic Group acquisition, and the stock still yields 4%. Is this the most underappreciated mega cap in the media and marketing world right now? We're diving deep into the world's second largest advertising holding company and what the IPG deal really means for long-term shareholders.
Omnicom Group is one of the world's largest advertising and marketing services companies, headquartered in New York, with approximately 120,000 employees across more than 100 countries. It operates a portfolio of creative, media, and precision marketing agencies serving Fortune 500 clients across virtually every major industry vertical.
In December 2024, Omnicom announced an acquisition of Interpublic Group that would create the world's largest advertising holding company by revenue. The deal is pending regulatory review and expected to close in H2 2026. TTM revenue is $17.3 billion, up 10.1%, and Omnicom's Q1 beat shows the underlying business is performing well heading into that combination.
Q1 2026 revenue was $5.85 billion, in line with estimates. EPS came in at $1.90 versus the $1.84 consensus, a 3.3% beat. That beat was driven by strong organic growth in precision marketing, healthcare communications, and media buying, partially offset by some softness in traditional advertising markets.
On a trailing 12-month basis, TTM revenue is $17.3 billion. Net income on a GAAP basis is negative $54 million, but that's entirely distorted by the Q4 2025 charge of $941 million tied to IPG acquisition-related goodwill and transaction costs. Adjusted operating earnings are solidly positive and growing.
The balance sheet has shifted significantly due to the IPG acquisition preparation. Cash stands at an elevated $6.9 billion. The company has been building liquidity for the transaction. Total debt is $12.8 billion, and equity is $12 billion, with total assets of $54.4 billion, reflecting the scale of the combined entity being built.
Cash flow generation is exceptional. Operating cash flow on a TTM basis was $2.9 billion. After capital expenditures of $150 million, very low for a company this size, consistent with a services business, free cash flow was $2.8 billion. That's a 16.2% FCF margin on revenue.
The stock trades around $100 with a market cap of $21.9 billion. The headline PE of 13.2 times is distorted by the acquisition charges. On an adjusted basis, the true earnings multiple is considerably lower, making this one of the cheapest mega-cap media names by adjusted valuation. The 4.01% dividend yield adds to the income appeal.
Pre-IPG, Omnicom was a steady organic grower in the 4 to 6% range annually. That's not flashy, but for a company with near $17 billion in revenue and this much free cash flow, consistent organic growth compounds meaningfully. The IPG deal, if approved, layers on additional scale and the opportunity for $750+ million in annual synergies.
Street consensus on Omnicom is cautiously constructive. Most analysts maintain buy or overweight ratings with price targets in the 115 to 130 range. The core thesis is that the IPG deal gets approved, synergies are delivered, and the combined entity trades at a meaningful premium to current levels as the integration discount fades.
The IPG regulatory review is the single biggest street focus. The combined Omnicom IPG entity would control a very large share of global advertising spend. Antitrust regulators in the US and EU are reviewing the deal carefully. Most analysts believe a path to approval exists, potentially with some agency or market divestiture requirements, but the timeline is uncertain.
Organic growth resilience is the positive signal from Q1. Despite the IPG overhang and global macro uncertainty, Omnicom grew organically. Healthcare communications and precision marketing, higher margin segments, were the standout growth drivers. This mix shift toward higher value services is exactly what Omnicom needs to sustain margins through the integration period.
Bears on the street worry about ad spending cyclicality. Advertising is discretionary. When recessions hit, marketing budgets get cut. Omnicom and all holding companies saw revenue declines in 2009 and again briefly in 2020. With macro uncertainty elevated in 2026 around trade policy and consumer confidence, any advertising slowdown would hit Omnicom's organic growth hard.
Digital platform disintermediation is the structural bear case. As Google, Meta, and Amazon capture more of the advertising dollar directly, traditional agency holding companies see their role shrink in the media buying value chain. Omnicom has been investing in AI-driven marketing platforms to stay relevant, but the secular pressure on agency commission economics is real.
The IPG synergy opportunity is transformative. $750+ million in targeted annual synergies against a combined revenue base of over $30 billion is achievable through shared technology, media buying consolidation, and overhead reduction. If delivered over 3 years, the combined entity's EPS could be substantially higher than either company on a standalone basis.
AI in marketing is an enabler for Omnicom, not just a threat. The company has been investing in precision marketing technology, data-driven targeting, creative automation, and measurement platforms. At the scale of combined Omnicom IPG, proprietary AI tools become a competitive moat that smaller independents cannot match.
The dividend is a powerful floor for the stock. At 4% yield on a business generating nearly $3 billion in annual free cash flow, Omnicom can sustain and grow the dividend through economic cycles. Income investors are effectively paid to wait while the IPG deal plays out. That carry makes holding through uncertainty far more palatable.
Regulatory risk is the clearest near-term bear catalyst. If the IPG deal is blocked or requires substantial divestitures, Omnicom absorbs significant transaction costs with no synergy payoff. The stock is pricing in deal completion. A regulatory block would likely result in a sharp derating as the acquisition premium evaporates and deal costs hit reported earnings.
Ad spending cyclicality is the macro bear risk. Holding companies are late-cycle stocks. They often hold up through the first phase of economic slowdown, but get hit hard when corporate marketing budgets actually get cut. If tariff-driven economic uncertainty translates into a 2026 recession, Omnicom's organic growth could turn negative.
Platform disintermediation is a slow-moving but real structural threat. Every dollar that goes directly to Google or Meta search and social advertising is potentially one less dollar flowing through agency holding companies. While Omnicom has adapted by building direct digital capabilities, the agency economics are under secular pressure that no acquisition fully resolves.
Talent retention risk is often underestimated in advertising mergers. Creative and media talent is highly mobile. If key agency leaders leave during integration uncertainty, client relationships can follow. Integration of Omnicom's and IPG's agency cultures, which are quite different, creates real attrition risk that could slow synergy realization.
WPP is Omnicom's largest global peer by revenue and the most directly comparable holding company. WPP has been restructuring aggressively and has underperformed in recent years. If the Omnicom IPG combination closes, the combined entity would surpass WPP in scale, shifting the competitive dynamics of global media buying significantly.
Publicis Group has been the relative outperformer among the large holding companies in recent years, driven by its early investment in data and technology through the Epsilon acquisition. Publicis trades at a premium valuation versus Omnicom precisely because of its data-driven differentiation. That gap could narrow if the IPG combination gives Omnicom comparable scale in data assets.
Interpublic Group is effectively being absorbed into Omnicom, so IPG as a standalone peer disappears upon deal close. For now, IPG trades near the deal consideration price, reflecting the market's expectation that the acquisition completes. The spread between IPG's current price and Omnicom's deal offer is the market's implied probability of deal completion.
Dentsu, the Japanese holding company, provides an international comparison. Dentsu has grown through acquisition in the digital space and has significant North American operations. It trades on Tokyo's exchange and faces its own restructuring challenges. Across all peers, Omnicom's 4% dividend yield and deal optionality make it among the most interesting risk-reward setups in the sector.
Options activity on Omnicom reflects elevated uncertainty around the IPG deal timeline. Implied volatility is above its historical average, suggesting the market is pricing in a wider range of potential outcomes than normal. Traders are using options both to hedge existing positions and to position for a regulatory announcement, which could move the stock sharply in either direction.
Insider activity has been relatively muted since the IPG announcement, which is expected given the legal restrictions that apply to executives during major M&A transactions. Watch the Form 4 filings closely once the quiet period ends after deal close or termination. Significant open market buying by CEO John Wren or the board at current levels would be a strong conviction signal.
Institutional positioning shows value-oriented funds accumulating Omnicom at current levels. The 4% yield and adjusted PE below 10 times are attractive to dividend growth and deep value strategies. Merger arbitrage funds have taken positions in both Omnicom and IPG to capture the deal spread, which adds complexity to the ownership base during the review period.
The biggest near-term catalyst is any regulatory update on the IPG deal, approval, conditional approval, or further information requests from antitrust authorities. A positive regulatory signal could push Omnicom's stock meaningfully higher as the integration discount narrows. A deal block would be a significant negative. Secondary catalyst, Q2 organic growth data confirming Q1 momentum.
Omnicom is a quality advertising compounder with a transformative deal catalyst and a 4% dividend yield acting as a carry floor. The Q1 beat demonstrates operational resilience even amid IPG integration noise. Regulatory risk is real but manageable.
At 13 times adjusted earnings with best-in-class free cash flow generation, Omnicom looks genuinely cheap for its quality. IPG synergies are the upside lever. The dividend is your income while you wait. This is a compelling hold with meaningful upside if the deal closes on schedule.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.